All right, so what do we have to know about pension accounting for the FAR exam? All right, what you probably already do know is that a pension plan is an agreement where the employer provides employees with a retirement plan in exchange for their current or past services. The pension plan itself is a separate entity from the employer who sponsors the plan. So the first thing that an employer does when they want to start a plan is to create a new entity, because the plan itself has its own financial statements separate from the employer's financial statements. So you wind up with two sets of statements. The employer has its own financial statements that include disclosures about the pension plan, and the pension plan entity prepares financial statements of its own since it's a separate entity apart from the employer. Now, the CPA exam has in the past covered the employer and the pension plan journal entries, but not anymore. Starting in July of 2021, CPA exam questions regarding pension plans are concerned with the pension plan itself, the separate entity, not the employer. So we're no longer determining pension expense on the employer's income statement. If you took the exam a couple of years ago, you probably remember that. We don't have to do that anymore. Now, CPA exam questions regarding pension plans are concerned with the pension plan itself, the separate entity. No more questions about the employer. And those old pension questions about the employer and how to calculate pension expense were quite challenging. So to get that out of the way, you don't have to do that anymore. It's a good advantage for you. So what do you have to know? Well, there's a defined contribution plan versus a defined benefit plan. You got to know the difference between those two types of plans. And speaking of two, there are two required financial statements for a pension plan, whether it be defined contribution or defined benefit. So a pension plan prepares its own financial statements, and you have to know that there's two required financial statements. And we'll spend pretty much the rest of this video just on what's on this slide here. And first we'll start with what's a defined benefit plan, one of the two types of pension plans. A defined benefit plan, the employer who sponsors a defined benefit plan promises each employee a defined retirement benefit for life from the day they retire. And employees work to earn these benefits while they're adding value to the company, and when they retire, they're promised a certain benefit, maybe 50% of final year salary for the rest of their life. That may be the defined benefit. Contributions to the plan are computed using estimates of future benefit payments, actuarial estimates they call it. The term actuarial estimates means a professional is needed because of so many unknowns. How much the employer has to contribute is based on estimates of stock market returns in the future, interest rates. The goal is for the employer to put enough money in so that each employee will receive exactly the promised amount. That's a defined benefit plan. In a defined benefit plan, the employer assumes the investment risk and the actuarial risk, the risk associated with estimates of future events, such as lifespan, number of years of expected service to the company. The employer assumes all those risks and must make up any difference to the employee upon retirement. And it's quite unrealistic, a defined benefit plan, because there's too many unknowns to be able to promise somebody 30 years from now, hey, we're going to give you this every year. So most companies do not offer a defined benefit plan. Instead, they offer a defined contribution plan, and an example of which is a 401k. A defined contribution plan, or a 401k, this type of plan provides an individual account to each employee. So each participant in the defined contribution plan has their own separate account. And a defined contribution plan defines the periodic contribution that needs to be made to the plan and the way that the contribution should be allocated to employees. Just like in your 401k, you know how much you're going to put in and how much the employer is going to match. And that's all the employer has to do, is honor that defined contribution amount. And then you, the employee, have to direct that money to a mutual fund or invest it in stocks or bonds or real estate. Whatever the amount is upon your retirement, whatever it grows to, is yours. The employer has no additional liability to make up any differences or losses or any employee needs at retirement. It encourages the employee to become somewhat financially sophisticated. This is a defined contribution plan. And that's the big difference between the defined contribution plan and the defined benefit plan is that in a defined contribution plan, the employee feels like he's playing a part in his own retirement because you're going to choose the investments. It's going to be up to you to make sure that money's invested regularly, because the employer is not going to be there for you upon retirement to make up any difference, because this is different than a defined benefit plan, which we've said is pretty much unrealistic. And the only place you're going to find a defined benefit plan today is in government. So what if they ask you this: in which of the following types of pension plans does the employer assume actuarial risk and investment risk? And that would be the defined what? That would be the defined benefit plan, letter B. So in a defined benefit plan, the employer assumes the investment risk, the actuarial risk also. The risk associated with estimates of future events, such as lifespan, number of years of expected service to the company, those are actuarial risks. Investment risk is the risk that the money didn't grow to enough by being invested in this or that, and so that the employer has to make up the difference. That's investment risk. So most companies, we said, do not offer a defined benefit plan anymore. They offer a defined contribution plan like a 401k. In a defined contribution plan like a 401k, the employee assumes investment risk, and there is no actuarial risk in a defined contribution plan because the employer does not guarantee the amount of benefits that the employee is to receive, nor does the employer base the contributions on how long they think the employee is going to work there or how many years they're going to live after retirement. That would involve actuarial risk. So in a defined contribution plan, there is no actuarial risk. In a defined benefit plan, the employer assumes the actuarial risk and the investment risk. Hey, who assumes the investment risk in your 401k? You do. That's right. So get involved in it and start figuring out what some of these investment alternatives are. The younger that you get sophisticated with that plan, the more you're going to have at retirement. All right, what about this one? The Drew Company contributes an amount equal to 13% of each employee's salary every year to be invested by an investment fund to provide retirement benefits. So 13% of each employee's salary is contributed. That's a defined contribution percentage. So far, it sounds like the Drew Company is using a defined contribution plan. At retirement, each employee receives the designated amount in the fund. Sure, whatever it grows to, that's what the employee gets. So that's the Drew Company. And if the question ended there, you'd say that the Drew Company is using a defined contribution plan. But here's more facts about the Rosen Company. They promise to pay each employee $100 per month after retirement, multiplied times the number of years of the person's employment. For example, a person who works 20 years will receive $2,000 per month until death. Well, that sounds like a defined benefit. Which of the following statements is true? You want the one that says the Rosen Company is using defined benefit and the Drew Company is using defined contribution. And that's letter C. Drew is using a defined contribution plan. Rosen is using a defined benefit plan. Let's try this one. In which of the following pension plans is the benefits that the employer is required to pay based on future events, such as how long an employee is expected to live after retirement? That would be defined benefit plan, letter A, but not defined contribution. So the answer would be letter A, defined benefit plan. Only in a defined benefit plan is the benefits that the employer is required to pay based on future events, such as how long an employee is expected to live after retirement, how many years they're expected to work for the company, how big their salary is expected to be towards the end of their career. That's only important in actuarial assumptions, and actuarial assumptions are only used in defined benefit plans. In a defined contribution plan, the employer only contributes to the plan and no actuarial estimates are included in that defined contribution. All right, what about this one? Which of the following types of retirement plans are not U.S. GAAP based? Defined contribution plan, defined benefit plan. Well, it just so happens that they both are U.S. GAAP based. A company could choose to have either one and account for it using generally accepted accounting principles. So both are GAAP based. So you got to go with letter D. Because GAAP allows for either a defined contribution plan or a defined benefit plan. And since the question is asking which of the following plans are not GAAP based, you'd have to say neither are not GAAP based, letter D being the right answer. Now let's talk about the two financial statements that are required by pension plans. Doesn't matter if it's defined benefit or defined contribution. They each have to have these two financial statements. There's a statement of net assets available for benefits, which shows at least 2 years of balances available for benefits, shows the total assets minus the total liabilities equals the net assets available to pay benefits to retirees. So it's like a balance sheet. Statement of net assets available for benefits. Assets minus liabilities equals net assets available for benefits. The second required statement of every pension plan is the statement of changes in net assets available for benefits. So I guess it's like an income statement, certainly more than it is like a balance sheet. It shows a change in the balances of the assets. So it wouldn't surprise me if they give you a question like this on the exam. Which of the following is one of the financial statements presented for a pension plan under U.S. GAAP? A, statement of financial position and benefits paid? Not really, that's not the title, right? B, statement of cash flows available for benefits? Not a cash flow statement. C, statement of changes in financial position? No. D, statement of changes in net assets available for benefits. I'm going with letter D here. I hope you can see why. Because there's two required financial statements for a pension plan. Letter D, the correct answer here, is number 2 down here. Statement of changes in net assets available for benefits. That's like the income statement. Then there's the statement of net assets available for benefits. That's the balance sheet that shows at least 2 years of balances. How about this one? For a defined benefit pension plan, the financial statement that shows the balances of the resources available to pay retired employees is called what? That would be the statement of net assets available for benefits. That's letter B. That's like the balance sheet. It's got to show at least 2 years of balances available to pay retirement benefits. All right, the statement of net assets available for benefits and the statement of changes in net assets available for benefits are required financial statements for what? Are they required for defined contribution plans? Yes, they both are. Are they both required for defined benefit plans? Yes, they are. So the answer is C. C is correct, both A and B. There is no cash flow statement, but there is a statement of net assets available for benefits and a statement of changes in net assets available for benefits. All right, for a defined contribution plan, the financial statement that shows the changes and balances of the resources available to pay retired employees is called what? Is that A, the statement of changes in net assets available for benefits? Sounds like it. Or is it B, the statement of net assets available for benefits? No. Is it the statement of cash flows? C? No. Statement of changes in financial position available for benefits? D? Nope. Let's go with letter A. Because the financial statement that shows the changes and balances of the resources available, that's the statement of changes in net assets available for benefits. Now here is a statement of net assets available for benefits. This is like the balance sheet where you show at least 2 years worth of information. Here's year 21 and here's year 20. The main thing on here, the reason why I'm going over this, not because I think the exam is going to make you prepare one of these, but just so you understand what's the focus of this statement. It's the assets, the liabilities, and the net assets available for benefits. Now, under the assets column, you're going to see investments. These are the pension assets, the investments that the pension plan has made, mostly in stocks, mutual funds, bonds, possibly real estate, depending on what the plan's allowed to invest in. So this is a 401k plan, which is a defined contribution plan, and the assets are shown in the plan at fair value. And you can see that the fair value increased because at the end of year 20, it was about 8 million, and then at the end of year 21, it was over 10 million. And while the investments is not the only asset, there's also some receivables here, but the investments, that's the major asset in a pension plan. The receivables include employer contributions, employee contributions, interest and dividends, and then there's the total assets. Then what are the liabilities? Administrative expenses and other payables, and then you have the net assets available for benefits. Notice at least 2 years of information is required, not just the current year, but the current year and the prior year. So what could they ask you here? Which of the following are found in a pension plan financial statement known as the statement of net assets available for benefits? Is it assets, liabilities, and capital? No, I don't remember capital being there. Additions, deductions, and net assets. I don't remember seeing additions and deductions on the statement of net assets available for benefits. Resources, claims, and net assets? No. Assets, liabilities, and net assets? Yes. D is correct. On the statement of net assets available for benefits, you have assets, liabilities, and net assets. So here's the statement of changes in net assets available for benefits for the year ended December 31st, year 21. Not because I think you're going to have to prepare one of these on the exam, but just know something about it. This is like the income statement for the plan. You have additions minus deductions equals the change, the net increase in net assets. So in green here I have total additions. We'll go through what those additions might come from. Then in red we have the deductions, and then the net increase in net assets. So here it's not assets, liabilities, and net assets. It's additions, deductions, and net increase in net assets. What's the biggest addition? Hopefully it's realized and unrealized appreciation in the fair value of investments because you had a good return year, either in the stock market, the bond market, real estate, whatever the assets are invested in. Then you have interest and dividends, and then you have things like contributions, employer contributions, employee contributions, rollover contributions from other plans. So here's all reasons why you would have additions to the net assets. And then there's deductions. And the biggest deduction would be benefits paid directly to participants. Retirement benefits paid. Then there'll be some administrative expenses, and there's your total deductions. So it's your total additions minus your total deductions equals your net increase in net assets. Hopefully it's never a net decrease. Then if you start with the net increase in net assets, here of $1,083,000, then you see there's net assets available for benefits beginning of the year and then end of the year. I don't think you're going to have to do much calculation on this, just to understand the flow. Something like this they could ask, which of the following is presented in the pension plan financial statement known as Statement of Changes in Net Assets Available for Benefits? A says assets, liabilities, net assets available for benefits. No, because this is not a balance sheet type of statement. This is the statement of changes in net assets. It's more like additions and deductions. Not net income though, so B is wrong. Additions, deductions, and net increase in net assets, that's looking good, letter C. And D is out because it's got assets and liabilities in it. So let's go with letter C. The pension plan financial statement known as Statement of Changes in Net Assets Available for Benefits presents additions, deductions, and the net increase in net assets. All right, in the pension plan financial statement known as the Statement of Net Assets Available for Benefits, there's a requirement to show at least how many years of balance is available for plan distribution, and you might remember the answer is 2 years. Letter D. On the Statement of Net Assets Available for Benefits, at least 2 years of balances are presented. Isn't that what we saw here? Right, we showed December 31st, year 21 and year 20. So go over this one more time maybe before your exam, and you should be fine for what they ask now on pension plans.